Hi, I am Anna. I come from www.ntvforex.com. Federal Reserve Preview Lower for even longer analysis. http ntvforex.com News ID 24C7729142020 10:06:58 a.m. Having announced the conclusions to their monetary policy strategy review, we will be looking to see what it means in practice for Federal Reserve decision making. The conclusion can only be interest rates will be held lower for even longer. The new normal AA averaging got 2% under the Fed's old regime. The policy was to preemptively raise interest rates before inflation got to 2%. This was based on the belief that the time lags between policy announcements and the impact on the real economy meant delaying action risked allowing inflation pressures to get out of hand. This could mean that either the competitiveness of the U.S. economy would be undermined or that interest rates would need to rise sharply to control price pressures, which could threaten an economic downturn. Numerous inflation downside misses over the years has since led to a change of thinking. The conclusions of last month's Federal Reserve Strategy Review showed that under their assessment of the new normal for the U.S. economy, both the long-run trend rate of U.S. economic growth and the estimates for neutral interest rates is lower than previously thought. In consequence, the point at which declines in the unemployment rate start to generate inflation has fallen, limiting the scope for a meaningful pickup in inflation. This can be seen in the numbers. Since the beginning of 2010, the Fed's favored measure on inflation, the core personal consumer expenditure deflator, has been at or above 2% in just 13 months, so a hit rate of 1 in 10, posting an average of 1.6% year-on-year over the past decade. The Fed to tolerate periods of inflation modestly in excess of 2% for some time. Significantly, the Fed acknowledged inflation shortfalls can be just as bad as inflation overshoots through dragging down inflation expectations and creating an adverse cycle of ever lower inflation and inflation expectations that lead to lower market interest rates, which gives the Fed less scope to cut interest rates to boost employment during a downturn. Therefore, to offer some compensation, they will now tolerate periods of inflation modestly in excess of 2% for some time, hence the shift to an average inflation target of 2%. The conclusion is that the Fed is now acknowledging they ran policy too tight in recent years. What does it mean for Fed policy? While there is unlikely to be any policy change this meeting given the decent activity and employment backdrop and the recent rise in inflation, we are assuming there will be a change of language within the statement given the Fed's shift in thinking. There will also be new updated economic and interest rate forecasts and a clear message from the press conference that interest rates will remain lower for longer than would otherwise have been the case. Currently, the language in the FOMC statement reads as the committee expects to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. In its new form, it will take on board the emphasis on a shortfall from maximum employment levels and a average for 2% inflation. Officials have also been mulling whether to formally adopt time guidance, such as saying interest rates will not be raised for 2 years. Alternatively, they could use outcome-based assurances, such as saying they will not raise rates until inflation has sustainably hit 2% and perhaps adding a figure for the unemployment rate. However, there is little real need at the current juncture given interest rate expectations are on the floor for the next few years and the Fed's diagram of individual members' rate hike projections is signaling nothing before the beginning of 2023. We are shifting to the view that we are quite a way off before the Fed needs to step in with more forceful language on the timing of rate hikes. Fed. Plot from June source Federal Reserve, Ing. Bloomberg. As for the new updated forecasts, we are likely to see growth expectations revised higher to reflect the recent stronger data. See our predictions of the new Fed forecasts below, with unemployment revised lower. However, we don't expect to see much change in the inflation projections nor to the interest rate predictions out to 2022. The June Fed. Plot diagram only had 2 of 16 members predicting a rate rise before end 2022, and we don't see anyone joining them. The interesting thing will be what they have to say about 2023 as they extend out their forecast range by another year. We tentatively suggest there is a consensus behind one rate hike before the beginning of 2024, but this is not a strong conviction call. We also wouldn't be surprised to see the long-run expectation for the Fed funds rate revised lower given the new thinking within the Federal Reserve. ING's expectations for Federal Reserve's new forecasts source Federal Reserve, ING low for a very long time either way. Jerome Powell will use the press conference to reinforce the message that the Fed has no interest in raising interest rates anytime in the next couple of years, which should help to anchor the short end of the yield curve even more sturdily. We also see little meaningful upside pressure on the long end of the curve coming from this week's meeting. There had been some recent upward pressure on longer-dated treasuries given anxiety about what that the Fed's renewed focus on delivering higher inflation would mean for fixed coupon payments over many years. Nonetheless, saying they want higher inflation and delivering it are very different things. With the U.S. economy continuing to face numerous challenges and the slack in the labor market meaning little prospect of wage inflation, the chances of the Fed meaningfully improving on its hit rate for 2% inflation anytime soon don't look great. The Fed will leave the door open to further potential action. In any case, Powell will leave the door open to further potential action, most likely involving additional QE, but will once again emphasize that the Fed can't generate demand. For that we will need to see additional fiscal stimulus, but that is looking only a remote possibility ahead of the November 3rd elections. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://m.me/mt5.expert.advisors.